Hello, ladies and gentlemen. Imagine you're aboard a ship navigating calm waters when suddenly the horizon darkens, storm clouds gather, and the once placid sea becomes tumultuous. This isn't a scene from a maritime novel. It's a metaphor for our current global economic trajectory. We're at a pivotal juncture. The indicators are flashing red, and the patterns are eerily reminiscent of historical economic downturns. It's not about fear mongering. It's about recognizing the signs and preparing accordingly. We're now facing a situation that has been building for decades, one that, if left unchecked, could have devastating consequences. It centers on something very basic, very structural: debt. But not just any debt. We're talking about levels of debt that are historically unprecedented and economically unsustainable. And what's alarming is how normalized it's become, how desensitized we've grown to trillion-dollar deficits, how easily we brush off interest payments that are now rivaling our most critical national expenditures. Throughout history, excessive debt accumulation has been a common precursor to the decline of great powers. You see the same pattern play out over and over again. A period of growth and prosperity leads to overconfidence and overextension. Governments borrow more to fund programs, wars, or stimulus packages, often with the assumption that future growth will make the debt manageable. But when debt grows faster than income, as it has now for years, there comes a breaking point. The current situation is not a matter of ideology. It's not about whether we should spend more or less. It's about simple arithmetic. The U.S. government has amassed over $36 trillion in debt, and it's growing at a rate that far outpaces GDP. Even more troubling is the composition of that debt. A large portion of it needs to be rolled over regularly, meaning that as interest rates rise, which they inevitably will, the cost of servicing that debt skyrockets. We're entering a phase where interest payments alone could surpass spending on national defense, healthcare, or education. It's important to think about debt in terms of obligations. When a government borrows, it is essentially promising future income to someone else. But what happens when those future obligations become so large that they can no longer be met through taxation or growth? That's when you start to see governments turn to money printing as a last resort. And while that may seem like a quick fix, history shows us that it comes with a very steep cost, often in the form of inflation, currency devaluation, and a loss of trust in the financial system. What's different now is the scale. We are no longer talking about temporary imbalances or cyclical downturns. This is structural. We've crossed a threshold where the compounding effect of debt is pushing us toward a debt spiral. And the more we delay addressing it, the harder and more painful the adjustment becomes. It's like ignoring a growing crack in the foundation of your home. It may hold for a while, but eventually it gives way. What we're witnessing now is the unraveling of a global order that has been in place since the end of World War II. For nearly 8 decades, the world operated under a relatively stable framework, built on U.S. leadership, rule-based systems, and cooperation among major powers. That framework enabled unprecedented global trade, capital flows, and relative peace. But as with all systems, over time, imbalances develop and eventually the cracks begin to show. The rise of new powers, most notably China, has shifted the balance. With that shift comes tension, economic, geopolitical, and ideological. We're now seeing an environment where global trust is breaking down. The institutions and agreements that once governed international cooperation are losing influence. Trade is becoming increasingly weaponized. Capital is flowing based not just on economic opportunity, but on political alignment. Sanctions, Tariffs and export controls are replacing dialogue and compromise. In this environment, countries are prioritizing self-reliance. Supply chains are being restructured not for efficiency, but for resilience and control. Alliances are becoming transactional, and the idea of a unified global economic system is giving way to fragmented spheres of influence, each with its own rules, standards, and currencies. Historically, this kind of shift has never been smooth. Transitions from one global order to another are usually marked by conflict, economic, and sometimes military. We're not there yet, but the trend lines are clear. The world is becoming more divided, and with that division comes greater risk of miscalculation, of conflict, and of systemic breakdown. Navigating this new landscape requires a sober understanding of history, power dynamics, and incentives. Because when cooperation erodes and competition intensifies, the margin for error shrinks, and the consequences become far more severe. Trade conflicts today are far more than just disagreements over tariffs or market access. They represent deeper fissures in the global economic fabric. When nations impose tariffs or sanctions, it's not simply about protecting domestic industries. It's a manifestation of broader strategic competition. These policies disrupt supply chains that have been carefully optimized over decades for efficiency and cost-effectiveness. The unintended consequences are often greater than the intended ones. When you disrupt trade flows, costs rise, not only for producers but ultimately for consumers. Businesses face uncertainty, making long-term planning difficult. Innovation slows down because companies become more inward-looking, less willing to invest in complex global networks. And history shows us that prolonged trade disputes rarely end cleanly. They tend to escalate, breeding mistrust and retaliation, which further undermines cooperation. The ripple effects extend beyond economics. Trade conflicts strain diplomatic relations and heighten geopolitical tensions. They create an environment where nations prioritize self-interest over collective progress, and that dynamic feeds a vicious cycle. Protectionism may offer short-term political gains domestically, but in the long run, it erodes the foundations of global prosperity. In past periods of protectionism, like the 1930s, the results were catastrophic economic contraction, rising unemployment, and eventually conflict. While the world today is more interconnected and complex, the risks remain. When countries erect barriers instead of bridges, the entire system suffers. It's a classic example of what we call a negative-sum game, where all parties lose more than they gain. Understanding this requires us to look beyond immediate headlines and political soundbites. The structural consequences of trade conflicts aren't easily reversed, and they set the stage for broader economic and political instability. Navigating these challenges will demand careful strategy, patience, and a commitment to rebuilding trust, without which the entire global system could fracture. In examining the economic landscape, it's clear that internal socioeconomic strains are becoming one of the most significant risks to stability and growth. When wealth and opportunity become concentrated in the hands of a few, the social fabric begins to fray. This isn't just a moral or political issue, it's an economic one. Inequality undermines consumer demand as the majority have less spending power. It limits social mobility, creating entrenched divisions that are hard to overcome. Political polarization feeds off this inequality. When large segments of society feel left behind or unheard, trust in institutions erodes. Governance becomes more difficult as factions prioritize short-term gains over long-term solutions. Compromise gives way to confrontation, making it harder to implement the kinds of structural reforms necessary for sustainable growth. These internal divisions have real economic consequences. They increase uncertainty, reduce investment, and slow innovation. Businesses become hesitant to expand in environments where social unrest or political gridlock threatens stability. Financial markets react to the unpredictability, and capital allocation becomes less efficient. Moreover, this socioeconomic strain often interacts with demographic shifts and technological changes, amplifying its effects. Younger generations may find fewer opportunities, while older ones may rely on strained social safety nets. Automation and digital transformation can disproportionately impact lower-income workers, exacerbating disparities. If left unaddressed, these internal pressures can lead to a downward spiral. Social unrest can disrupt economic activity, leading to slower growth or even recession. Political instability can deter both domestic and foreign investment, further weakening economic fundamentals. Addressing these challenges requires more than superficial fixes. It demands thoughtful policy that balances growth with equity, builds trust in institutions, and fosters inclusive opportunity, because ultimately, an economy divided against itself cannot sustain long-term prosperity. We live in a time of rapid technological advancement, where innovation reshapes industries and economies at an accelerating pace. This transformation brings immense opportunities, but it also introduces significant disruptions that compound existing economic vulnerabilities. Technology, automation, artificial intelligence, and digital platforms is altering labor markets fundamentally. Jobs that once provided stable incomes are being displaced, often faster than workers can retrain or adapt. This creates not only economic dislocation, but also social tension, as communities struggle to find footing in this new reality. At the same time, environmental challenges are becoming impossible to ignore. Climate change, resource depletion, and natural disasters impose costs that ripple through supply chains, infrastructure, and public health. These disruptions strain government budgets and corporate balance sheets alike, often hitting the most vulnerable populations hardest. Unlike traditional economic cycles, these shocks are not easily managed with monetary or fiscal policy tools alone. They require coordinated, long-term strategies that integrate economic, technological, and environmental considerations. What makes this landscape particularly precarious is the intersection of these forces. Technological change can both mitigate and exacerbate environmental problems. For example, renewable energy technologies offer solutions but require substantial investment and infrastructural overhaul. Conversely, digital transformation accelerates consumption patterns and electronic waste, complicating sustainability efforts. The combined effect of these disruptions introduces layers of uncertainty that make economic forecasting and policy making more complex. Investors face challenges assessing risks. Businesses must balance innovation with resilience, and governments need to address both immediate crises and long-term structural shifts. Navigating this era demands adaptability, foresight, and collaboration across sectors. Without this, technological and environmental disruptions threaten to destabilize economies already under pressure from debt, geopolitical shifts, and social divides. Recognizing and preparing for these multifaceted risks is essential to building a durable economic future. History doesn't repeat itself exactly, but it often rhymes. By studying past patterns and recognizing current signals, we can better position ourselves to weather the impending economic challenges. Stay vigilant, stay informed, and remember, preparation today can safeguard our tomorrow.